Hi, friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And today we are so excited for our conversation with new Wall Street Skinny bestie, David Adelman, whom we met at Global Alts at iConnections in Miami back in January. We got to have a really fun conversation with him then, but it was super brief. It was like our red carpet introduction. And this is a full deep dive on everything from real estate investing to venture investing to sports investing. David has done it all, and he is one of the coolest stories that I think we're going to hear because his investing journey started literally the day he turned 13. So I think that that's very different from the majority of our investors who were like, this was a journey that I really didn't expect to go on, and I suddenly found myself here. Yeah. He is, it's like a great American story. It's one of the coolest things. He is amazing. Yeah. And his wife is amazing, by the way. We talked about this after the fact, but major shout out to his wife, who we totally want to get on this, but apparently she is an Oscar-nominated documentarian. So documentarian, is that a word?
I don't think so.
Creator?
Sounds like an octogenarian.
Documentarian. But yeah, so just a really cool family, and we're so excited to get into it. So before we do, what we really want to highlight are some of the things that are going on in the news this week. This is actually, it's funny, the markets have really been center stage, I think, more than some of the deal stories for the first few months of the year as we've been acclimating to the new administration. But I think now we're starting to see some really exciting deal activity. And Kristen did a ton of work for this week's newsletter, and she's been putting out some newsy items on our social media. So Kristen, I really want you to talk about some of the deals that you were focused on and get into why they're so exciting.
Yeah, I mean, look, I have said this before that I'm finishing up this M&A course where it's, I've obviously just been in the weeds in like the whole M&A story. And so the fact that you had Google, they announced that they were doing an acquisition of Wiz, a cybersecurity firm. It's a $32 billion deal, which is the largest that they have ever done. So this is a company that they actually had made a bid on, I think last year, and Wiz rejected it. Their revenues are basically doubling annually. They had like $500 million of ARR last year, and they're projected to earn $1 billion this year. But what's interesting is, the market didn't like it, which is not surprising. By the way, in general, markets, or I should say investors, often are very skeptical of M&A and believing that when a company buys another company, they're actually going to be able to justify like what is paid. M&A oftentimes destroys value for the shareholders. And so I think that that's obviously part of it. From, I harp on this when we get into the M&A course that like there's this difference between valuation and affordability, where it's like, people often talk about what is the company worth. If you're an equity investor, you kind of care more about like, well, I care about my claim on the earnings per share. So what happens to that? So like that can often be more of a reflection of the stock price. And so what's interesting, and again, I'm putting together a reel on this, and we talked about it in the newsletter. We had gone through and talked about like why they likely chose to do it as an all cash deal. And it's not just because, by the way, they have more than enough cash to cover it, because even if they have enough cash to cover it, it's not a done deal that they would even use cash. There's a very good chance that they would raise debt. And for the same reason, Jen, we were talking about this, like you can have a ton of money in the bank and still decide you're going to buy a house and you're going to get a mortgage, because the cost of borrowing is often like less than if you could actually, than if you put your money in the markets. So just because they have the cash doesn't mean they will use cash. But then also, what do you need to believe? What does Google need to believe to make the math work? Because, if you're thinking about, okay, they're paying $32 billion for this business that had $500 million of sales, that's a 60 times sale multiple. Now, yes, they're growing 100% next year, so that would be a 30 times sale multiple. But still, if you're thinking about it from an EPS accretion dilution standpoint, there's a lot that needs to happen. Really, it's sort of synergies to make the math work. So we kind of break that all down, which is kind of fun. And the craziest part of this whole deal is that there is a $3.2 billion breakup fee. So what that means is that if for whatever reason, like it could be that the administration blocks this deal from going through. If that happens, they are literally on the hook to pay Wiz $3.2 billion for like the pain of them having like not closed the deal, which is insane. That's a 10% of the purchase price. Most deals in that size are like 1% to 2%. So anyway, it's a really interesting acquisition. I think next week there's also a few IPOs specifically in the AI space. So we're going to try to like focus a little bit on that. One of the other things we also tried to break down this week was some tax rules. And as we get into like this conversation about Trump tax cuts and like what's going to actually make it into the final bill, private equity firms are lobbying to get some interest tax deductions back. So I know it doesn't sound sexy, but again, for anyone who's interested in like private equity, like it actually can have a meaningful impact. Is something that I think a lot of people are maybe not aware even exists now. So if you haven't already done so, a plug for the newsletter, check it out. And you also can go watch our video on Instagram. So yeah.
Well, I think two things around that. One, it's not just private equity firms, right? Even though they're the ones
100%.
lobbying for it.
Yeah.
This is a change that would impact every single corporation that borrows money and has to pay interest. So I think that that's one of the things that I observed kind of being lost in the noise, rather, of people responding to your video in the comments.
True.
People are like, oh, it's a Republican administration. They're going to do whatever big companies want, blah, 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 blah. Like they'll give them tax cuts. It's like, hang on. This administration, the first time around, is actually
put the limits on. Yeah.
that put these limits on how they could deduct in order to fund other tax cuts.
Yeah.
And if we're talking about different ways to stimulate the economy, well, okay, we're also talking about different ways to reduce the deficit, right? And so if this change were to go into effect, I think Bloomberg was estimating this would add something like 180 billion to the existing US deficit. Every single action that's taking place is being done to try to reduce that deficit. So weighing the cost benefit analysis of, okay, what are we doing to stimulate businesses versus reduce the deficit? Like, which is the higher priority now, and to what extent? So it's a much more nuanced conversation than I think some people appreciate.
Well, you make a really, really good point. So the reason that private equity firms care so much is that they tend to have this strategy called leverage buyouts, where they buy companies that put a ton of debt on it. So for them, like the whole idea is that basically you can deduct interest up to 30% of EBIT. That is a limit that was actually recently dropped. It used to be EBITDA, which is a higher number. So basically private equity firms are lobbying to get the DNA put back in, is kind of the quick summary. But to your point, you could also be just a regular business where maybe you're not super levered, but interest rates go up enough, like you could be tripping those limits. So it could affect regular businesses, not private equity firm backed ones owned by private equity firms. But so that's a really good point, that this is a rule related to companies. It actually is not related to private equity firms. Then there's the whole carried interest conversation that I also think we need to do another video on, because they've been talking about getting rid of that for years. And that's a loophole that actually it was cut for hedge funds for the most part, but it has not been cut for private equity. So we'll see, because we'll see. I don't know. I think that they might make it. Who knows? I don't know.
Anything's possible. The other thing that it's funny, you were talking about how quickly Wiz's ARRs, its annual recurring revenues, are expected to grow. And it reminded me of a big story that actually one of our very loyal Instagram followers, Benny the Storyteller, sent us before it kind of became a more popular story. There was this scandal with a startup company, a tech startup company that JP Morgan acquired. And it came to light basically that this company was representing that they had, I forget however many hundreds of thousands of users, right, who were active subscribers. And it seems to me like JP Morgan did zero diligence on reaching out to any of these actual subscribers and being like, hey, can you verify this? Because after they acquired the company for, what was it, like $175 million? They then found out that the vast majority of these accounts were fabricated. That the CEO had allegedly, because this is going to court now, allegedly paid one of these like bot farms to start all of these fake accounts with made up email addresses. So, I mean, it's just crazy, because you think about the projections for growth for some of these AI-based or tech companies, and it's all based on numbers like these, right? And so I know nothing about Wix. This is not to imply, by the way, that Wiz is at all fraudulent.
Oh,
Not at all.
Yeah.
I cannot imagine what the diligence is like to verify the projection that this company is going to quite literally grow by 100% year over year. That's wild. So,
well, I think they were started in 2020. So they've basically made it to this point. But I mean, obviously, like as you get bigger, it can be harder to grow. At the same time, if you now are combined with Google, I feel like it sort of turbocharges things. I think they're going to ultimately make it work personally, like if I was a betting person, but who the hell knows?
Well, and nobody wants to pay a $3.2 billion termination
breakup fee. Yeah. Well, especially for the deal. I mean, how horrible would that be if it's literally like, I mean, it's out of your control. It doesn't go through because like it gets somehow tied up in antitrust, and all of a sudden you have to pay.
That's what I don't understand. To me, that seems like the kind of thing where a breakup fee shouldn't apply, like because it's totally out of the hands of the two parties concerned.
The idea that you could be on the hook for that amount of money because somehow it gets like caught
because
up
of
in
like
a
the
court
whim
battle
of a judge or a politician.
Or a judge. Yeah. Exactly. So I don't like not being in control of things when it comes to that. So that to me is just wild.
But like if I didn't do my due diligence and there's tens of thousands of fake accounts, you know what? I deserve to get that back. Like I'm a dummy. Okay. Like
I remember when that story came out, I think there was something where there was like in one of the files, like in an Excel file, there was like a random number generator or something. It was actually like not that hard to figure out that these were fabricated.
Right. It would have been like very simple.
Yeah. And it was something that was like, oh shit. Like if you were the banker on that sucks to be you. Like you really effed up.
Well, so pivoting back to our podcast today, one of the other things that we're going to talk about, David has invested across a whole number of different verticals, but one of the investments that he's made recently is in a liquor company and a spirits company. I don't know what, like an alcohol brand, right? And so he's got a different,
sounds fancier.
A couple of them spirits. I know it also sounds like mystical. Like,
yeah.
And I think it's actually a really interesting kind of counterpoint to the episode we did with Carl Radke from Summer House, where we talked about Soft Bar, his new venture that's launching, that is a non-alcoholic, like social entertainment space. And we talked about a lot of the backlash towards drinking and social events. We talk a little bit in this episode coming up, but we've talked also in the past about, Kristen, you did a reel talking about what it's like being pregnant at a work event and not drinking. And we were just so shocked by the reaction in the comments from some of our younger followers who were like, why would you feel pressured to drink? Like what a strange thing. Like we can't imagine that. And we're like, well, sorry, what planet are you living on? Like it was such a thing back in the day.
It was a little more aggressive than that. It was kind of like nobody should care. Like, why do you care? Nobody notices. And it's like, oh no, people notice. But it's not so much that you're being pressured. It's that you don't want other people to notice you changing your behavior. Because I do think there's culturally in the Wall Street world, it's sort of like if you want to bond with a group of people, like you go out, you get drinks, and look, it loosens you up a little bit for better, for worse. And I think the binge drinking culture is not ideal. The grabbing a drink after work, I don't have a problem with that.
Well, not only do I not have a problem with, I'm very pro. I actually really like alcohol. And so where I was going with this is I by no means just because we really support the addition of these new non-alc spaces as options for people because of what that reel represented was like, hey, listen, like, are there places for, let's say you are pregnant, or let's say you just don't want to drink or whatever, like, can you go out? Can you bond with your coworkers? Yeah. But for people who do enjoy alcohol, myself being one of them, I really like alcohol, although you wouldn't be able to tell because last night I went to a wine night for like the third grade moms and I was so tired that I was like, I never do this. I like never say no to a glass of wine, but I just want like a spin boost, you know? But I actually really enjoy like a really nice alcoholic beverage. I just do. Like
I'm the same way.
Oh yeah. They're just the first sip of an ice cold martini is so, I feel like Tom Wamsgans in Succession, like when he's worrying about going to jail and he's like, they don't have Chardonnay in jail. Like,
and he's like wants to make the toilet wine. He's like talking about how to make it.
Wine. Yeah, yes, exactly.
And then they start a vineyard.
That would be me. Yes. Not that I never want to go to jail, but I would be researching how to make toilet wine in jail.
Don't fake some accounts, Jen.
I won't. But there is just, I'm sorry. Like, you know, top 10 feelings is like when someone delivers a perfectly made martini in front of me and it's just like that first sip, I just, everything is right in the world. I probably sound like a crazy alcoholic. I swear to God that
you
I'm
don't.
not,
I mean, it's funny. You actually don't drink that much. Like, I feel like you're very much like, it's like for certain occasions.
I'm a take it or leave it person now. I did the work back in the day. Like I left it all on the field when it was college and like my days on Wall Street. Like I drank for like a 250-pound man's worth of drinking.
I mean, again, that was kind of just like the culture. But back to the point though, on this alcohol stance, I think that I am a little worried and I was actually a little bit not relieved, but I liked that it was interesting. And I told you this because you were like, I'm researching some gummies, sativa or whatever.
Oh, well, let me tell you the background for that before you tell your story about the podcast you listened to. So I went out to dinner with a big group when we were in Park City. And this is a group of people in some form or another that I've dined with, drank with, partied with, et cetera, plus some new additions whom I hadn't met for 2 decades plus. Yeah. And I was actually really shocked because normally at one of these dinners, it's like, 15 bottles of wine, like everyone's drinking cocktails, like all this stuff. And a lot of people at the dinner were eating gummies. Mm-hmm. And there were maybe 3 bottles of wine between like 10 or 12 people.
Wild.
And like, you say wild, right? Like that sounds like and it was still like a 5-hour dinner. So it was a very tame dinner as far as consumption goes. I was just shocked by the choice by so many of these people who grew up being like just very active consumers of alcohol to now lean more heavily on gummies. And so I was bringing that up to you that I was like, I guess I should research like whatever is going on with these gummies, but like, I don't want to be asleep at a dinner. So I was trying to learn the difference. And then you were talking about a podcast that you listened to. So sorry to interrupt you, but I wanted to give that context.
Well, I think it was interesting because Scott Galloway was talking about how there is this epidemic of loneliness amongst the younger generation. And I think that there are a lot of people that are choosing to stay home, maybe scroll through Instagram, maybe whatever, TikTok, like pop a gummy, but also just like not be as social. And I think that, he was saying as bad as it is for your health to have some alcohol, like also the act of going out, being social, mingling, and by the way, making bad decisions, which probably will lead you to like meeting the significant other, like who you may want to ultimately have a family with one day. The upside, you know what I mean? It's like a risk reward thing. Like I 100%, actually think,
by the way, when we hit end record on this episode, we were asking David how he met his wife. He was like at a bar, right?
Yeah.
The old fashioned way.
Honestly, that's how I met my husband. I met him at SantaCon. Like, granted, he worked with my brother, but my brother was so excited to introduce me to his quote unquote boss because we were out at a bar. You know what I mean? Like we were on a pub crawl, and that's how we ended up meeting. And like, I think that was similar for you. Like again. Not that.
No, I met my husband at work.
Like, but you didn't. Okay, never mind. I guess that's true. But also,
like, literally walking by each other on the way to the desk. I was probably stomping around looking angry.
But I think that again, it's one of these things where pendulums always swing so far. It's like
too
much drinking is obviously bad. Like,
also, too much drinking of crappy stuff. Like, one of the things that we talk about with this specific brand is David was like, I wanted to create a luxury drinking experience that you could like sip and enjoy that wasn't meant to be masked in jungle juice. And I'm like, honestly, if that is the kind of drinking culture that had been present when I was in college, rather than like consume as much Milwaukee's Best as possible, I think I would have had a much healthier relationship with drinking in my teens and 20s. And it wouldn't have been about binge drinking. It would have been about truly enjoying the spirit, if you will. But
I think the conversation. This goes to everything. Everything can get taken to an extreme. And I think that things that are seen as healthy can very easily do this. And I've talked ad nauseum before about like my issues where I used to be so healthy that I was wildly unhealthy, right? It was
like the wellness nonsense.
It was an eating disorder. Yeah. Like some of the wellness nonsense where people are like, I'm not going to put any poison into my body. That's like not blah, blah, blah. And you end up with a place where it's like, you're now not enjoying life. And it's also, I think, having it takes a toll on your mental health. And actually on your physical health. Like, so there's so many things where, again, people tend to take things to such extremes. And I am such a centrist with everything. Yeah. It's like everything in moderation, whether it's politics, I don't care. I just like, let's not be crazy. And it goes for everything, whether it's like anti-drinking, whatever. So sorry, and rant.
No, I don't think that's a rant at all. I actually saw a video pop up. It was an interview with Jonathan Haidt where he was talking about the anxious generation, that book, and kind of the genesis of writing that. And if you have to boil down the thesis of that book, what he basically said is we are overprotecting our children in real life and we are underprotecting them on the internet. And I think that you can almost think about like the approach to drinking culture as that in a heightened extent, if you will, where we're so worried about, oh my gosh, all these terrible things that can happen when you overconsume alcohol, when you put yourself in dangerous situations, right? That we don't engage in them at all, but instead are going online, doom scrolling, like you said, and being like, well, I opt out of life. I opt out of accidents. I opt out of accidental partnerships, whatever it is. The only parenting book I ever read was it was called like The Blessing of a Skinned Knee. And like, think about how many times we skinned our knees making dumb decisions around drinking or going out to bar or whatever it is, right? Like all that fun
You
stuff.
learn pretty quick. Yeah.
And you do have some, like, there were some disasters for sure. Like, there were some disasters of judgment that we've made throughout the course of our lives. But how great to have those little lessons learned. You need to learn those little lessons so you can avoid the broken bone, like the big injuries. So you want the skinned knee instead of the broken bone. And like, also, honestly, what if you could just enjoy like a drink?
But
like, it's
this
just not that big a deal.
No, but I mean, this actually ties completely back to the conversation with David Adelman as well, which is like, you have to also sometimes risk something bad happening. A, to learn, but like B, to actually make something good happen. And it's like one of the things with my middle child where she doesn't take risks. And like, that's one of the things that we need to like get her. So she's not so afraid of not being perfect, because if you don't take risks, then you don't, like, you're going to fail. Learn. Like the first time you don't learn. So yeah, it all comes back to like, at the end of the day, people have to make mistakes. You don't make mistakes, you don't learn, right? Like, I don't know. So yeah. And also,
so have a martini. And
I can't have a martini yet, but I will. I'm so excited to have one. I'm like counting on the days.
Sound like such alcohol 13. We're not, but like, it's just like, have fun. Live life. All right. Well, I love this episode. I'm so excited to hear it. Let's bring David on and we'll get to it.
Awesome. All right, so we are so excited to be joined today by David Adelman. And David is, I mean, his resume is insane. So he is the CEO of Campus Apartments, co-founder and vice chairman of FS Investments, and founder of Darco Capital. So you're going to have to kind of explain to us some of the differences there. You're also an LP of Harris Blitzer Sports and Entertainment. And if that wasn't enough, part owner of the Philadelphia 76ers, New Jersey Devils, and a soccer team. I'm not as familiar with soccer, but Crystal Palace, which again is for our UK listeners, football team. So anyway, there is so much going on, and you have, like I said, just such an impressive resume. And so we would love for you to just share with our listeners a little bit of how did you come to build this empire that you have? Because I know that you really worked your butt off to get there. So can you share a little bit about just how you even got involved in Campus Apartments and then grew it to what it is today?
Sure. Yeah, it's hard work and a lot of ADD. That's really what it comes down to. Well, I'm excited to be here with you guys, so thank you for having me. The Campus Apartments story, it's somewhat known, but it's just a cute story, and I'll tell it. And
cute story.
Well, it's just weird because it's like one of those stories where I have a family friend, the kind of guy you call your uncle growing up that's not really your uncle or your aunt. Like people have those all growing up, and with almost 4 kids, I'm sure you have a fleet of them, right? And so for me, Uncle Alan Horowitz, who with his mother founded Campus Apartments in the late 1950s. Alan is like a serial old-time entrepreneur real estate guy, like just like the old timers. And it's a generation, unfortunately, that, not many of them are left. And literally he taught me the business as a kid. And so the story goes, Uncle Alan was over our house. I'm 11 years old. I'm playing basketball with Uncle Alan. Most kids, when you're betting somebody, they let the little kid win. So I guess I said to Uncle Alan, I bet I can beat you. We're playing basketball. He didn't let me win. He said, I'm going to, and so I said, I'll bet you. And not only did he not let me win, but he like roped me into betting more stuff. Okay. Oh, no. So I lost my basketball, my football, my baseball glove. And then when I was a kid, you had like a savings book called a bank book, right? Mm-hmm. And I lost my bank book. Oh. And literally I had to go down to Campus Apartments, his company, sweep sawdust, stack lumber, and do this little stuff for what felt like, 12 hours, and it was probably an hour. But I had to do that every week, and each week I got something back. Mm-hmm. Okay. So like, he was going to teach me about work ethic. And my parents were like, oh, this is great. Really, teaches responsibility. My gambling addiction is over. We resolved that when I was 11 years old. So we don't have that anymore to contend with, thankfully. And I just learned the business. Like as a little kid, I just would go down and visit Uncle Alan and just remember that. And then 2 years later, for my bar mitzvah, I had $2,000 of gift money. And my parents were like, do you want to give it to your grandfather who was a stockbroker? And I was like, no, I want to give it to Uncle Alan and I want to do what he does. My parents thought I was out of my mind. Like, they're like, what? And he was down for it. And so literally he's like, well, which building do you want to invest in? I was like, well, I don't know what you have. And so, I'm sitting here in Philadelphia right now, and his portfolio was surrounding the University of Pennsylvania student housing. Mm-hmm. And so literally we get in his car. I'll never forget. He had a Corvette, because I still remember that as a little kid. I thought it was a cool car. And we're driving around what is University City. And he's like, we have that one, this one. And I'm like, that one.
Mm-hmm.
He stops and we get out and I'm looking around and I was like, I want to invest in this one. And he's like, why? I don't understand. And I'm like, because it's the biggest one. I'm 13 years old. I don't know shit about real estate. What do I know? But I did. I handled it like a drug deal. I hand him a bag of cash of $2,000 and or like a bookie, and I'm off to the races. And I was really fortunate because he had a great knack for not only real estate but the way he taught it in a really simple way, and just taught me the business as a kid. So I worked there, in high school. He had me doing maintenance, construction, painting apartments, accounting, leasing apartments, all the different jobs that you would do.
Mm-hmm.
Then I worked for him during college, during summers and breaks. And literally I went to Ohio State. I graduated on a Thursday and I started working for him on that Monday. So that's kind of how I got started in real estate. And then I was really fortunate because not only did he get me started, but he put up money and let me buy buildings and really just taught me the business. And I was fortunate because it was a great business, very nichey, even as today. But even back then, I'm talking, in the mid 90s, that it was really niche. And I was like, no one's doing this on a large scale. And I said to him, I was 26 or 27. I was like, I think we should do this nationally. And that kind of got us going.
That's amazing. What are the other schools, I guess? Because I know in the Philly area, but literally everywhere.
Yeah, we're in about 23, 24 states. It varies because we buy, we sell, things like that. So Michigan, University of Central Florida, we have 3 at University of Arizona. We're in Texas. We're in Clemson. We just sold an asset down there that we built in 2017. And so for us, we buy really beautiful state-of-the-art still, we'll build it brand new luxury. The way students are living today is insane. If you saw our gyms, it looks like an Equinox. And then we'll buy, renovate, all of those things. And we house today about 25,000 students across the country.
Wow. And I'm curious, so is this separate from the school? Because for example, I went to Brown and I remember they guaranteed student housing and there was the dorms and then there was the off-campus housing. Is this the campuses? This is the apartments, or this is separate?
This is so let's assume you live in the dorms your freshman year.
Yep.
And then off campus, we are everything kind of after that. So off campus, where you're going to live with, it could be a group house, a group apartment, anything like that. There is a small portion of our business where we will build dorms and build on-campus housing, but it's not a huge part of our business.
Interesting. I actually wonder, especially because these schools need to increase the size of their classes. And so I feel there's probably such an amazing opportunity over the next however many years, because they really do. It's insane. The class sizes are the same size that they were when we went to school, which is
it really depends on the competitive nature of the school.
I guess that's fair.
Some schools are growing. Generally the Ivy League schools are not.
Right.
They kind of have a capped infrastructure, capped enrollment. And so, that might not be a place where we want to go and buy or build because there's, the supply and demand. It's any business that you guys were in, from Wall Street or not, where's the supply and demand on both sides?
Yeah.
If there's equilibrium, you don't want to be there. You don't want to add to it or disrupt it.
Yeah.
Well, so building on that, what are some of the fundamental tenets of commercial real estate investing on this kind of scale? If someone wants to approach this and say, okay, I want to become the next David Adelman. I want to be this kind of investor. What did Uncle Alan teach you? What are those fundamental tenets, and what are kind of the basic 101s, other than again, buy low, sell high, supply demand dynamics?
I think the best thing about real estate is it's such a unique business where, your power of leverage, right? So, if a building costs $1 million, you can put $700,000 of debt on it and you need $300,000 of equity, and your customers, your residents, are paying your debt service, right? And so it's such a unique business where your customers are paying your bills. And so kind of the nature of real estate in its simplest form is over time, you are going to amortize that $700,000 loan down. And over time, that $1 million building will appreciate. And so, if all goes modestly according to plan, okay, and let's just say, kind of 3% compounded growth, you're going to be at kind of $1.4 million, $1.5 million, right? It's compounded. And that $700,000 loan is going to be down to, call it $450,000. And so you've created almost $1 million of equity in there, and your original equity was $300,000, right? So can you put a new loan on, recapture your original equity, maybe you pull out more and roll it into the next deal? And that's, to me, that's it in its simplest form of, there's generally long-term attractive financing in place. Real estate is unique, other business too, but mostly real estate, where your ability to have a one-way option on locking in your financing for 10 years. So, we just did a round of financing about 2-3 years ago where we were able to go long-term, 10 years, at like 4%. Rates are, 6.5, 7 now.
Yeah.
That, so you think about what are the controllable expenses, and your debt service is such a large portion of your income that it goes to that. So to me, like the fundamental component of real estate, the other piece that's really simple that Uncle Alan taught me is, if you're full, 100% full, your rents are too low.
Yep.
Right?
Yep.
Right. And if you're not full, your rents are too high. I mean, again, in its simplest form, right?
Sure.
There's an algorithm to figure that out.
And I'm curious, when you talk about like this niche of the market, it's kind of genius, right? These universities are going to have this demand, right? Like this is a constantly replenishing population versus say other types of commercial real estate where it's like, well, we think about, the return to work orders and like how much are people coming back into the office and ground floor retail versus online shopping, et cetera, et cetera. Are there other areas of real estate that you've expanded into where maybe you've had to take a little bit of a different approach than you did with campus apartments?
Look, you nailed it. The captive audience of student housing to me is like no other. Traditional apartments, if you're in the right place, or workforce apartments and there's a steady flow of job creation, things like that fill your apartments, that's great. But that captive audience is what's kept me in this business for so long. I dabbled in the hotel business. I built a hotel here at Penn. And like, it's fine, but like you're at the whims of a market. The person whose flag is on your building, they get 9% off the top for having their reservation system. That's the best business in all of real estate is where you just get 9% off the top and you don't have any capital committed. There's been cycles in other businesses where people are like, oh, retail was really great. For a long time, people would do deals with like CVS and Walgreens and these, Rite Aids. And, they would sign these long-term leases and they would just keep clicking them out. And then, lo and behold, like Walgreens has an issue or Rite Aid or one of these, they go through their credit ratings drop. And now that piece of paper that you thought was an annuity isn't. And so I'm kind of like a slow and steady guy. So slow and steady in apartments wins the race for me. Real estate's been, a great place to versus private equity or some of the other businesses. I always say real estate's a get rich slow business.
Well, it's interesting too, because there was a big article on Bloomberg about how some of the more traditional private equity shops are now starting to move to a more diversified model. I think it was KKR Holdings or whatever, right? How their model now is these big, sticky, long-term investments like real estate that are a divergence from their kind of old bread and butter business model for this exact reason.
Yeah, I mean, I think everyone, in those big outfits, they're into every bucket, right? Every corner of the financial services world. So for them, it's just an asset allocation.
Well, I remember actually when I moved to New York City, I was in like 2006, the building that I ended up living in, I think it was bought by Blackstone like the next year. So yeah,
you were in an Archstone building, right?
Yeah, I think it was Blackstone that bought them right either before or after the financial crisis. But speaking of private equity, it's funny because you were explaining how real estate works and like that. For me, as a teacher who has always explained the private equity model of you buy a company heavily levered up with debt, similar kind of idea. And then you like watch as like the business is slow, boring, steady. It's the same thing, right? You want to buy boring businesses. You're not looking for the tech startups, right? You're trying to find the boring businesses that you can put a lot of debt on, grow it slowly, and then pay down the debt. But so I'm interested how you then pivoted because again, you obviously became CEO, are wildly successful with campus apartments. What exactly is FS Investments? And then also, can you talk a little bit about Darco Capital, what they are, how they differ, and like how you kind of entered into that space to begin with?
Yeah, very, very different businesses. FS Investments is in the asset management business. We run about $83 billion of capital in a series of strategies. Predominantly, I don't know if you guys know what a BDC is, a business development company. A BDC is a wrapper, like a mutual fund or a REIT, okay? So it's kind of like a tax wrapper. And we run a lot of capital in those strategies. Those vehicles then become lenders to private equity-backed companies, big in the debt space. And, then we've gotten into real estate lending and a lot of different alternatives. And our goal was to figure out how to bring alternative investments to the masses. So if you're a client at Morgan Stanley or UBS, you can get an FS fund and invest in it. We have two that are listed on the New York Stock Exchange, and you could just buy it direct.
Wow.
And so the goal there was to really bring alternative investing to the masses in a way where, you mentioned Blackstone or KKR, they started out being for really high net worth people, right?
Yeah.
So you need to, you guys know this, you talk about it on your show all the time, you need to be accredited, high net worth individuals or institutions or pension funds were really the clients there. I thought there was a gap in middle America where they had an opportunity to kind of access alternatives.
You were such an early mover on that, by the way. Like now it's like everyone's like, oh, I want to put private equity in your 401k, right? Like
exactly. Yeah. I mean, we started that business. I have a partner. We started that business in 2007. So,
that's insane.
Wow.
Like that's 15 years before anyone else had even like had an inkling about it.
We were definitely early, and we saw that. We thought, that was kind of the right move. And what I think about is when you think about stocks and bonds, I don't really own stocks because I've never been smart enough to figure it out, and I would always buy at the wrong time. And so, but like, think about what happens in stocks and bonds. People generally, they buy and sell at the wrong time, right? Like they hear something's running up, they go in at the top, and then they sell because they're panicked. And the alternatives can generally ride out the storm because they're longer duration, right? And that lack of liquidity actually kind of gets you through a bad time. Not always, but many times. And so that's what I appreciate about it.
No, that's what we say all the time. You can put money in the stock market, and then it's like you have this temptation to pull it out at the lows and buy at the highs. The lack of liquidity almost helps you because it's like it takes away your worst instincts.
It lets you ride through a bad time because, and generally like those bad times create more opportunities. So if the fund has liquidity, it's buying more at those moments.
Mm-hmm. Yeah. I mean, we're kind of in a curious position right now. In fact, when there's so much volatility in the public markets, I know that there had been so many predictions for higher deal volume coming into this year. And when we all spoke at iConnections at Global Alts just 2 months ago, that was every conversation we had. It was like, let's go. We're off to the races. Like there's going to be epic deal flow. There's going to be so much investment. But what we've seen is a little bit more of a mixed bag in the first few months as everyone's trying to figure out what the actual direction is, right? Whether it's of the economy, whether it's of where interest rates going to be, what's overall risk sentiment like. I'm curious, as an investor, what's your take on the tone right now?
To me, I thought it was way more positive than negative, and I think it is. I think you're seeing more liquidity in the market. I think you're seeing regional banks that weren't lending now opened up for business. I think you'll see, the signal is that there'll be less regulation against those smaller banks because why should they be held to the same standard as the bigger guys? Regional banks are really the ones lending to small and mid-sized businesses, right? Where they do it every day. Not that the big guys aren't, but they're just not as focused on that. And so I think if you see money flowing to small and middle market businesses, I think that creates way more deal volume and transaction activity. A lot more M&A, things like that.
And then how does Darco Capital fit into the portfolio of, again, everything you have going on?
Yeah, and we'll come back to it, but it was like an accident how we started FS. I'll tell that story in a second. Darco Capital, as FS and the real estate became more successful, I had the opportunity to have a little more personal liquidity, and I was like, well, what am I going to do with it, right? And so I created Darco Capital, which is my family office, and I needed to pick what I mentioned to you. I'm not a good stock investor, never have been. It's for me because of the FS business, I have to clear trades, and it just was like a little bit of a pain in the ass. And I was like, probably not going to do that. I got approached. This is kind of weird through the campus apartments business by lots of consumer companies that wanted to do business with that college demographic. Right? You think about they're on mom and dad's payroll, disposable income. They're also kind of thought leaders and tastemakers of trends. And so I had lots of consumer products. I'll tell you a couple examples where they were like, hey, we have a new energy drink. Can we drop that off at your pool parties, every weekend for free? I'm like, sure. And so the students are getting this new energy drink. And then someone's like, hey, can I drop off? Microsoft early in the day would be like, hey, we want to put our Xboxes at your properties to try it.
Genius.
Right?
Oh my gosh.
And I could give you a list and list.
You were like the original influencer.
Well, so I was like the conduit to the I was like the dealer, right? I was the gatekeeper. And what we noticed was everyone wanted access to these students, whether it was consumer, financial services, you name it. And finally, I was like, God, I just keep kind of doing this. Should I get something for facilitating? Should I do something? So I was like, I'll put it out here, but you got to let me invest.
Yeah.
And so I started investing in a bunch of consumer businesses. All different things, I'm an investor in GoPuff. I'm an investor in, different, kind of consumer products. And
full disclosure, I don't know what GoPuff is. I'm going to frantically Google it.
All right. GoPuff. So GoPuff is kind of like what DoorDash is to a restaurant. GoPuff is to a convenience store. Okay. So those and they do meals now, but it's more about hey, I want snacks. They start
you
out
need something from 7-Eleven.
Right. So they start out doing ice cream and beer. Okay. This is like 15 years ago. It's two young guys from the Philly area. I mean, it's now a $7-10 billion business.
Wow.
They've crushed it, and they're just great guys. But college kids was right up that alley. I was like, oh, I'm going to invest. And so I started doing that. And then I would say we started institutionalizing the investment that we were making, both in consumer, but then we were doing fintech. And what I found is no different than I like, talking to folks like you on podcasts. I like mentoring kind of leaders. And so I was making investments, but I was also spending time with the founders.
Oh, you're their Uncle Alan.
Right, exactly. God, I'm probably older than Uncle Alan was when he met me, now that I think about it, but who knows? But the thing that I enjoy seeing people succeed. And like, I feel like all of us in business, if you've made mistakes, why allow someone else to make those mistakes? Yeah. And so like I have a saying in all my businesses, make lots of mistakes, but don't make the same ones twice.
Yeah.
And so like, I'm always about like sharing my experience and like more about my mishaps than my success. Like, don't do these things. And so I think Darco became a place that founders could go that was kind of like patient, understanding capital. I mean, and look, we competed against VC funds and things like that. And I was never always the lowest cost or the best deal. But what I promised everybody is when it's sunny and 85 degrees, the typical pick your VC fund, they'll be great. And what I would say is, and I was wrong for a long time, I was like, it's not always going to be sunny out. There's going to be rain. And like, sure enough, COVID comes and a lot of these companies had good businesses. They were struggling cash flow wise. And the VC fund was like, hey, we're not making investments. We're not doing follow-ons. And we did. And so I think people respected the fact that we stood by our companies during a tough time. And we didn't do it in obnoxious or like overly aggressive terms that some people were doing. And I think that gave us a reputation that they're like, hey, these are people we want to work with.
Right. Yeah.
And so, we're small, we do a handful of deals a year. And that's really what Darco is. And so, we probably have 100 investments in different things. Wow. Some of them, many of them have gone to zero, and some of them have been totally amazing.
And are they investing in like the early stage, like seed stage, or are you where in kind of the life cycle are you making these investments?
Yeah, we're seed in A generally. It doesn't make sense for me to just as a new entrant go in and do the growth capital when there's some $1 billion fund that, you've already de-risked the business and there's someone willing to do that. I mean, there might be a rare occasion where I'm doing that because it's synergistic to one of my other companies, but it's usually
what kind of deals are you seeing come across your desk these days? Is it all tech? Is it all AI based? Or are you seeing more of these like really creative consumer products type things that you originally were looking at?
I'm seeing, everything has like the word AI on it, whether it's AI or not, right? And so like you have to dig through that. And I'm still trying, like I'm not there yet on having figured it out. I'll be honest with you. The consumer is still there. The biggest thing that happened is up until about a year ago, I think founders were not respecting capital. And there was so much capital.
More. What do you mean?
So what I saw was you would see founders that were so aggressive on their terms and their asks. And the market was really flush with money. So
because there was just free money everywhere.
There was free money. So like literally like a year and a half ago, I said to the guy that runs investing for me, I was like, we're going to stop investing. And he's like, whatever, it's frothy. I'm like, exactly. I was like, I said, founders are like doing these deals. And then you're seeing other like venture funds doing these like exploding term sheets that if you didn't sign it in 24 hours, the terms went away. And I was like, I don't want to play this because I saw that in 2008, 2007 in the real estate world.
Yeah.
So I had seen what happens when things get frothy. And like, I feel fortunate, like by a little bit of luck, like we shut down investing in real estate, at the end of 2007. Like it was just
like you kind of have like the recession-proof edge in the real estate market, right? Like kids are always going to college,
especially they go that well.
People were still overpaying and pushing up prices for product.
Yeah, that's right.
And leverage. People were putting 90% leverage on deals. Yeah, and I was like, that just doesn't feel natural to me. And so, like when I start not understanding something, my reaction is to kind of like, whoa, time out. So like,
I want to double click on that, by the way, because like you have said more times on this call, I think, than the average bear that like, I don't understand this. So then it's a signal to stop or whatever. And I think that level of humility and self-awareness is something that a couple of other people that we've talked to recently, most notably Karen Carnell-Tambor, who's a friend, who's the co-CIO of Bridgewater. She's always just like, but why? But it doesn't make sense, but why? And I think that ability to identify, hey, this doesn't make sense to me. I don't know everything, but if I don't get this, I'm not going all in. Like that really, to me, that's how I feel about AI, actually. I'm like, I don't really get this. So like, maybe it's overhyped. Yeah. I don't know. But like, I am not a savvy investor like you. I think that that's such a key skill that more people need to be attentive to.
So you're clicking on something that I preach about. Like, so I love talking to college grad students, like young professionals, because again, I want to just share the mistakes. Mm-hmm. And so that's one of them. Like, how many people, and early in your careers, people would be talking about something. You're like, what the fuck are they talking about?
Yes.
Okay. But like, no one raises their hand to like get clarification. Yes. And you leave that meeting hearing something that you don't understand for the next year or 2 years. And you're like, what am I doing?
I have told this story ad nauseum of how I was sitting in a meeting for a tolling defeasance project when I was at Lehman Brothers. And they were like, we're going to take all these tolling contracts and we're going to put them in a AAA rated CDO. And I was like, they're underwater. How is it going to be triple? They were like, no, we're just going to rate it AAA. And I was like, but how? And they were like, shut up, dumb first year analyst, like whatever. And I was like, okay, I guess I just don't understand CDOs. Like, I'm so sorry. And like, no, the emperor had no clothes, right? Like
you did understand.
That was like such a core memory of like, I don't get it. But I had no confidence in my own ability. So I was like, if I don't understand it, the problem must be me, not the product, not the environment, not the market, right? So I think like knowing the difference is so critical.
I teach everyone, like, speak up when you don't understand. I think people respect it more. Like, can you explain that to me? I just don't get it. Like, I think it's totally refreshing. So I couldn't understand why the capital was giving founders such an edge on deals. Like, deals have to be good for both sides. Mm-hmm. And when deals stop being good for one side, like, I don't know why people are doing it other than the asset managers or those funds. Their only goal was to push the money out to get to the next fund. Mm-hmm. And so I saw a lot of that and I was like, I don't understand that. I don't understand how people don't care enough about the capital to just rush it out the door on behalf of their investors. Mm-hmm. Because again, like wearing my campus apartments hat, part of our business is we're in the private equity fund business where I raise money from individuals or pension funds or institutions. And like, I want to respect the capital. Or at FS, we have to respect the capital. We have shareholders and investors. And so like, I was just like, I'm never going to do something that I don't understand because how can I explain it down the road when if it falls apart?
Yeah. Right.
So like to me, that not understanding. And so what's interesting is I think venture has, had that snapback a little bit now. Founder expectations are almost back to where I think they should be. I don't think it's there yet, but it's getting there. The capital's kind of like, oh, wait, we're the money.
Yeah.
We can dictate the like, so I think there's people are being a little smarter about it, which I'm happier to see kind of that balance.
Yeah. And again, I think that the whole thing with DeepSeek, where they were able to create this AI model and it was so much less cost intensive, like the numbers are probably not exactly correct, but one of the arguments was almost like the US starving them of certain resources forced innovation. And I do think that, again, if you're a founder, I mean, Jen and I obviously started this and honestly, like having to be resourceful and like be scrappy and not just be like light money on fire. Like, oh yeah, we're just going to, I think that it makes you smarter. And I think it makes you figure out how to do things in a way that is just better in the long run. And you figure out how to innovate almost by having almost a little bit of scarcity. But
100%. I mean, like, innovation comes out of circumstances.
And necessity. Yeah.
So how did you go from running, again, more of like a real estate business to then focusing now on the investing side with FS Investments? What was the spark that lit to actually say, hey, I want to start this business? And then how did you actually go about building it?
So let's talk about the transition from campus apartments to FS. And so campus apartments, Uncle Alan and I are here in Philadelphia. And then I'm like, hey, we should do this nationally. And, in fairness to him, he was kind of like, if you're going to want to do this, like you're gonna have to be on the road a lot and doing that. Like I have no interest in that. And so literally like I was 26 years old or 27 and he's like, you should run the company. And so I started doing that and growing regionally, again, under the model that I told you, you do a deal, you create some value, you refinance, pull your money out, do the next deal. And we had done that and never had partners or investors. And then in 2006, we got approached to go public as a REIT. And I had thought about it. There were a couple firms that wanted us to go public. At the time, he's still one of my best friends, and you guys probably know him, Michael Rubin was running a really small public company here in Philadelphia at the time. I was like, hey, I'm thinking about doing this. And he saved me because he was like, don't go public. You don't want to run a small public company. Wait till something else happens. And then I was fortunate. One of the investment banks was like, why don't you do a private round, scale campus apartments, and then discuss going public.
Yeah.
And so I wound up raising a $300 million private round. I'd never raised $1 before. This is like actually a good story. And I run this kind of global process, and an international sovereign wealth fund gave me $300 million in 2006 to scale campus apartments.
Wow.
That must have been wild, going from like, this is just us, to now we have $300 million from a total outside investor. Yeah.
And of course, like, real estate developers. So of course I was like, it wasn't just the $300 million. I was like, this is $1 billion with leverage, right?
Right. Yeah.
So like I put out, I'm younger. So like I put out, campus apartments, creates $1 billion joint venture with this sovereign wealth fund to, kind of blow up in the student housing space, because we were pretty early in it. And I'm thankful we didn't go public. I do realize that I am probably not employable, right? And so being a public, like you have to know your weaknesses, and you have to know. And
we aren't anymore either. Don't worry.
Yeah. So like I was like, I don't think I could be a public company CEO and deal with the analysts and deal with all of that. Yeah. So it was a good trade for us. But that led me on the pursuit where I met somebody who was doing alternatives in a non-traded REIT format. And it opened, so publicly registered, but not publicly traded. So it's like a private fund that's publicly registered. It was really interesting, but they sold shares. But it was a way for middle America to have access to real estate, kind of like in the 80s, there were these like syndicators. This was kind of the next evolution.
Would you mind giving us a 20-second primer on REITs? Because it's something we haven't talked about on this podcast. You are way more, I'm the next best qualified, and like, that's not a good look. So like, I'd love it if you could give our listeners just like the quick and dirty of what a real estate investment trust is.
All right. REIT 101. Okay. A REIT, a real estate investment trust, created in the 60s, 70s, or 80s. They've been around for a long time.
Yeah.
And the goal was, they are a bucket that you could buy shares of. That bucket is going to buy buildings. The benefit is that structure, the REIT election, which is really just a tax election, I don't want to get too technical here, requires the real estate person, whoever's running it. Okay. So Jennifer has a REIT. She's running it. She has to distribute 90% of the income to its shareholders. So there's requirements of what you do. And so a REIT's a great vehicle because it was a large scale way for investors, instead of buying IBM or Microsoft or Apple, you could now buy shares of real estate companies. And so it was a great diversification.
Yes.
Everyone always says, like, for years, all my friends are like, hey, I want to get in the real estate business. I'm going to buy a couple houses. And I'm like, you do not want to get maintenance calls at like 2
such concentrated risk,
right? When somebody's toilet overflows. But like, I'm like, invest in a REIT.
Yes.
Okay. Because that is a bucket of real estate that, you can then have access. And by the way, cross diversification, different geographies, different product type. That's perfect. So this company was selling shares in REITs to middle America through smaller broker dealers, not the wirehouses. And I was like, this is an amazing business. And it opened my eyes up to the fact that the country was so programmed to stocks and bonds.
Yes.
And not other things. And I was like, why aren't we offering other things? Why isn't somebody doing it? And as you get to know me, you'll learn, like, I'm kind of like, well, why not me? Well, I'll do it. Right. Because I couldn't find anyone else really doing it. And so like, I have a great partner in the business, and we sat down and we figured this out. And so cool. We then figured out a wrapper. We're like, well, people are already doing this in real estate. Is there another place to do it in alternatives? And that's how we created the BDC. The BDC already existed. Again, it's just a wrapper, like a mutual fund or a REIT. And we were off to the races.
How did you get involved? So you're running your real estate company. You're now doing more of like a financial services type firm. And then also on the Darco side, you have the consumer retail. How did you now get involved to sports investing? Because you are an owner of, again, multiple different teams. Like, how did that come to pass?
Yeah, so it's interesting. The Sixers first came for sale in, I think, 2011 or 2012. Okay. And, Philadelphia guy. And so Michael Rubin and I were like, we should buy the Sixers. We were here. There were like two problems. One, we were both building our businesses. Okay. He was really focused on Fanatics at that point to kind of grow it. I was building FS and campus and everything else. And two, we didn't have enough money to buy the team. A small detail. But like we could have, we probably could have raised it or whatever. But long story short, Michael wound up investing with the guys who did it, who are now my partners, Josh Harris and David Blitzer. And then immediately Crystal Palace and the Premier League came for sale, and I wound up going in on that deal with them. I wound up being, very close to the guys, and Michael ultimately needed to sell his stake because Fanatics was getting into sports betting.
I see.
And so as gambling, you can't own,
Makes sense, yeah.
Yeah, so
seriously.
The NBA and the NHL, because we own the Devils as well, we're both like, whoa, you got to get out. And so literally one of my closest friends in the world, we made the deal literally in like 2 minutes.
Wow.
We agreed on the number, and I bought him out, and then I became the third largest partner in that business. And it's been great. I'm really fortunate. I have great, I pride myself on doing business with people I like and people respect. And I have 2 great partners in Josh and David that just are really make it fun.
So then what brought you to want to invest in like the New Jersey Devils? Do you have any ties to New Jersey, or how did that come about?
Nearby.
Okay, so fair question. They had already owned the Devils when I bought into it. And, it was a tough thing to swallow as a Philly guy, that I was like, am I going to wear the gear? Like, am I going to get a rash if I wear it? Like, what happens? I do now have some Devils stuff in here, and like I have, I share the love a little bit between all of it. And honestly, it's been great. I mean, the Devils fans are passionate. We also own the Prudential Center, the building they play in, which is amazing because it's in Newark, New Jersey, but it's the 7th highest grossing arena in the country.
Is that right?
Wow.
Yeah, we have a really good team that operates that business in that building, and it's a really great venue.
Like I was telling you before, we had sat down with someone who gave us the 101 level of, this is how you think about valuation of an NFL team. This is how you think about the valuation of an NBA team. This is Major League Baseball. How does hockey fit into the mix? How do hockey teams make money? How do you think about valuation of hockey teams? Like, where is the money coming from? How much is national? How much is local? Like, how does the split work? I'm just kind of curious because I haven't heard the kind of 101 on just that aspect.
Look, they all to different degrees, and we also own a piece of the Washington Commanders, which again, as an Eagles fan, we talked about that. That's kind of weird for me as well, riddled in conflict. But look, the NFL has the best business model in sports because of the value of their TV contracts, right?
Right.
And you think about what they make from TV and the scarcity value, and they've managed to organize the TV contracts all in one, so it's basically one bucket of money, where in basketball, hockey, you have national revenue and then you have local revenue. And so the key for hockey, the Devils, since we've bought them, have continued to rise in valuation, and our fans are great. And so look, obviously selling out your building is important. The key to really making money in hockey, and by the way, basketball, is the playoffs. The playoffs are what really make you money.
That makes sense.
Okay.
Incremental TV revenue, incremental ticket revenue, concession revenue, millions of dollars are made in the playoffs.
Wow. So you have to make it to the playoffs.
Yes.
The main thing.
Right now, knock on wood, the Devils are should be okay. And then look, how deep do you go? Is it just the first round, or if each round is like another pool of capital?
Okay.
And so, piggybacking on that question, also the ownership of Crystal Palace, I'm curious about Premier League and what I know nothing about the mechanics there, and that must be very different from an NFL, NBA, NHL. So that was my simultaneous question, Kristen.
So it's
I want to know
basically like
about
the 2 other
soccer,
sports.
but you want to know about hockey.
Premier League is really unique.
Yeah.
More Wild West. These are David Adelman's. That's not a professional opinion. That's just my my personal view, because there's no salary caps.
Yeah.
Right. And so you're basically competing with governments that own teams, right?
Yeah.
Look, that's the crazy thing, is that there's 2 things that are really crazy that I'm like, holy shit. Like, one, like you're competing against sovereign wealth funds.
The sovereign wealth fund could invest $300 million, and you could easily have just spent that on a soccer player and not thought twice.
Well, how about this? Number 2, do you know what relegation is?
Yes, only because of
I don't.
Ted Lasso.
All right. Okay. So great show. By the way, our stadium, Crystal Palace.
Oh, no kidding. Really?
That's so cool.
Cool.
Selhurst Park. But so what relegation is? This is wild. It's like the greatest thing in sports. Like, if every sport did this, you'd be like, holy shit. So think about, like, in baseball, you have like the pros, then you have AAA, AA, single A. That's different levels of minor league underneath it. What they have is they have different levels. So you have different leagues, right?
Mm-hmm.
And so if you are below the bottom 2 teams, okay, is it 2? Yeah, I think the bottom 2 teams each year get relegated down to a different league.
Yep.
But the best 2 get promoted up.
Mm-hmm.
I mean, so by the way, like your revenue drops drastically. It's like Lord of the Flies, right?
But it's so exciting too, because there's like the stakes are so high, and then you want to watch the teams that might get promoted.
Correct.
Like, it's a genius idea.
It is like it's just gangster. It's really crazy. And so like you're just hoping like as like a team owner, you're like, all right, just keep me in the middle of the pack. That's okay. Because to your point, like to be like the top 6 in the Premier League, you really are competing with like very deep money.
Spend.
Yes.
Oh my God, I cannot even imagine.
Yeah.
Well,
and so are you? I know nothing about Crystal Palace. Are you in the middle of the back? Like, where are you?
We're okay. Yeah. So we're good right there.
Okay.
We had an early season scare, and we're hanging in there now.
Oh, that's awesome. And then talk to me about owning the buildings, because we talk about selling out these stadiums, right? But like, again, I imagine that the business model of owning a stadium or an arena or whatever it is, and we talked about this on our original episode with you, but for those of you who are crazy and didn't listen to that, even though you should, you are now building a new arena. So like, talk to us about that, because I imagine that side of commercial real estate is very, very different than campus apartments. Or maybe not, but maybe there's a lot of similarities, but.
So look, obviously the product type is very different. My wife, when I was like 3 years ago, I was like, I'm going to lead the effort to build a new arena for the Sixers. She's like, well, what do you know about building an arena? I'm like, well, the truth is, like, when you think about how many arenas there are in the country, like, it had to be somebody's first time each time. So like, why, I come back to why not me, right?
Why not
me? Yeah.
And look, the process itself of like planning, organization, design is the same, no matter what you're building, like that piece.
Yeah.
Having the information to like make sure you're building what product you want, what it should look like. How do you do something in the future that's going to be different? Look, I'm obsessed with it. I've been at this 3 years. Like, my goal is to build the best live entertainment venue in the world in Philadelphia to open in 2030. Like that, it's literally what I think about every day. And you talk about economics, and what we're doing here is, in this case, we currently play in a building where we are the tenant, not an owner.
Mm-hmm.
The Flyers own the building and we're a tenant. By the way, similar relationship that Boston has.
Yeah. Well, that was going to be my segue into you knew where I was going with this.
So, we notified Comcast, who owns the Flyers, of our intent to build our own home. We spent a couple of years pursuing our own option in downtown Philadelphia. Fortunately, through a lot of hard work and a lot of, different relationships, we came back together and agreed that we were better together and are going to build this great new venue together in South Philadelphia in what is our sports complex, kind of adjacent to where our current home is. And so, the difference this time, instead of us being a tenant, we'll be 50-50 partners, sharing the economics, really do it together, create something really world-class. I'm privileged that I get to be kind of the lead and do this. And it's great for Philadelphia. And I think it's going to be great for the leagues to design, because you've had a bunch of new buildings that just opened. Intuit Dome for the Clippers. Golden State opened one a couple of years ago. Milwaukee did as well. And you think about those buildings were probably designed, 3 to 4 to 5 years before they opened. Mm-hmm. And so like the building that we're going to open in 2030 hasn't even been thought of yet. Right. So that's what gets me really excited. I mentioned our experience in running the Prudential Center. And so we know what it means to operate in there. We only have one pro team, the Devils, and the rest are all live events and things like that. And so, we do over 240 events a year there. And so really thinking about what the building of the future should be is something that's really exciting.
And so, for example, like if the team got sold, it sounds like the stake that someone would buy is both the team and the arena. Like they're kind of the package deal.
Yeah.
So that was what
you consider it all together. Yeah.
Got it. Okay. And that actually then brings us to the question that we had. So there was just last week, it was announced that, again, Jen and I are Bostonians. So, cared a little more, but like for us, we paid extra attention to the fact that the Celtics were just sold in a unprecedented deal that set multiple records, like not just for the NBA, but for like sports teams, period. Or I guess like outside of, I'm not sure, soccer, given like what we talked about, that might be its all.
It topped what my partner Josh Harris paid for the Commanders too.
Right.
Sports,
Yeah. And so the crazy part about it, well, there was so many interesting parts to the story, because number one, it was like a tiered deal where they're buying 51% now, and then they're buying the remainder in like 2028, which, given sort of what we've seen with past deals, has not worked out that well. So like, that seems like an interesting way to structure the deal. Number two, it sounds like, I don't know exactly what the financing is, but they had an offer that was basically like fully financed through PAGS. And I'm going to butcher his name. Apparently he lives, by the way, Jen, in our hometown, but he had like a fully financed deal, and they went with one that was not fully financed, that might have debt and private equity money. And then finally, I mean, the Celtics, they're a tenant in the Boston Garden, or I think it's now called the TD Garden, versus actually owning it. So I don't know. I'd love to get your perspective on this. Is it just a trophy asset? Like, what would be the rationale for kind of doing this type of deal at this price? And I don't know, just any of your thoughts on seeing that.
Yeah, and look, to be clear, like, I only know what's publicly available about the deal. And candidly, like, I hate the Celtics because they have not been kind to the Sixers. So I'm just putting that out there.
Totally
I'm just kidding. Literally, like, I was at a party last year, and Wick showed up with the championship trophy. Like, it was a great feeling for him, nauseating for me. And I really like Wick. But no, the Celtics are great, and like there's just a great rivalry with the Sixers. But so look, I think what you said, that look at what they're paying and how is that worth it? People have been saying that for the last 10 years in sports. Every time a record is set, like, what that guy's nuts, what they're overpaying, like that's a crazy number. And like that's been going on for 15 years, that there's always a record. And look, the truth of the matter is there's scarcity value. Yeah. Okay. It's 30 teams. That's it.
Yeah.
And then you put on the fact that, I understand the guy who's I don't know him. That's his hometown team.
Yeah. That's fair.
And so like, I know what it's like, at least for me with the Sixers, to be involved in your hometown team. Like, there is a civic pride that you get, which, by the way, when you're winning is great. When you're losing, it's not fun. That's a whole separate conversation. But I get it. Like, again, the scarcity value. It's a storied franchise. It's great for the business. And look, my guess is one of two things will happen. I have no information here. One, they have a lease. That lease will mature at some point in time. I don't know how much time they have left on it. And the owner of the building is either going to make them a great offer to stay, or these guys will, want to build their own arena. Like, I'm sure the new owner has that calculus in his head. Like, I'm going to have to do something, and I might have to come up with $1.5 billion to build a new building, or, maybe they do it together, like us and Comcast, came together ultimately and did. So I think there'll be more to come on that at some point.
I'm curious, as someone who owns a team, do you do the same math in your head that you do from a real estate transaction standpoint, as like, this just restruck the comps for my teams? Like, this now resets the valuation. How does the valuation of another sports team all of a sudden cause you to reset your own mark to market?
When the house next door to you sells for more than your house you thought was worth,
everyone's partying.
You're happy, right?
Yeah.
Look, it's good for business. So I don't think there's an NBA owner out there who's upset with the number. And so I think we're all happy. And I think, but again, we know that we have a precious asset. And I think when you look at it too as owners, while it's fun to own a team, like what I always say, and I don't want to speak for other owners, but Josh, David, and I, we look at this as like a public asset that we're the stewards of. Right. And, for some hopefully long period of time, and, hopefully our families beyond that, but you have that asset, they've been around for a long time. Okay. Sixers been around since 1946. There's been several owners who have done, made, contributions along the way, and you just hope to do the same thing. And, I'm just hopeful that we can add a couple championships along the way.
You mentioned the phrase civic pride. For some reason, that got me very emotional. I feel like that's something we don't hear about as often, especially coming from young people these days. What made you feel so deeply tied to Philadelphia? Why is that such a core part of your identity? Again, I grew up in Boston. I don't care. Whatever. I'm location agnostic. It's not.
Jennifer, you're my favorite person for calling me young. So we're besties now. I do feel it, and I'm probably more in tune to it than maybe others, because I've gone through this 3-year process of deciding what we should do with our team. Should it be built downtown? Should we come together with, the Flyers and Comcast? Philadelphia is my home, so civically, I've been working with the mayor and governor on how we can do things to rebuild Philadelphia. So I do think about it that way, and I know my partners do as well. And I think most of the folks, by the way, the Crafts are very close friends of mine. I can't think of another family in sports that doesn't feel that civic pride for what they've done, for Boston and for New England with that team, right? And so I think there's lots of great examples in sports of people who do it. I'm probably, you've caught me at a moment in time where I've literally spent the last 3 years of my life, like really in it, community meetings, getting, tomatoes thrown at me, to say the least, and it's been rough. And so you go through that for a place you love and care about.
Yeah.
I knew you went to Ohio State for college, but other than that, have you been in Philly your whole life? Like, did you?
Yeah, I came home. I've been here.
I think that must be part of it. I will say, growing up in Boston, like, never, I was like, oh, I could care less. Like, I hate Boston. I moved to New York, was in New York for 17 years. And then I moved back a couple of years ago. And I will say, Jen, I do think it changes. I don't know. For me, I think a part of it was also like having kids here, which is like, and maybe that's partly for you too. I don't know.
That's a great point. I feel more of a civic connection to Charlotte, having been here and raised my children here, because I feel like I'm investing in this city because my children are here. It's not just about me. Like, who cares about me? So I think that's really good insight, Kristen. And then separately, another, talking about shifting cultural attitudes a little bit, another really exciting business venture that you have been involved in is an alcohol brand. And we were talking, we had a conversation offline literally yesterday, and we were so excited to get to talk to you about this today. We were talking about some of the reactions we had. Kristen is pregnant right now, and we had posted a reel on social media talking about what it's like being specifically a woman who's pregnant at a work outing and being like, oh, I'm not drinking, and how to deal with that pressure. And we were blown away by some of the comments on that reel from young followers who were like, what do you mean? I never feel pressure to drink, whatever. We grew up in like peak binge drinking millennial, like college is for keg stands and all that. And there has been a shift in attitudes, I think, culturally with the younger generation towards alcohol as a whole. We are both like, I don't know, pro alcohol. Like, we are consumers of alcohol in our day-to-day life. I love a martini. Like, a lot of my friends these days are tequila drinkers. Tequila is huge right now. Can you talk to us a little bit about what it's been like developing an alcohol brand and marketing it to kind of a changing consumer? And I'd also love to talk about that in the context of what's happening with tariffs.
Yeah, I've only been in the business about 3 years. Okay.
You did a lot in the last 3 years. Jesus.
Yeah. So I've gotten back. I've been an investor. So I'm an investor in the Tequila Lobos with LeBron and a bunch of people that are friends of mine. Our vodka, a shameless plug here. Like,
no, plug away.
So American Harvest,
You gotta try it.
And the uniqueness of this was, by the way, I'll give you the business story.
Yeah.
I thought it was crazy that when you look at other alcohols, tequilas, bourbons, you can like name like 3 or 4 brands out there, right? Like that are out there, like tequila. Don Julio, Patron, Casamigos. You could like think of things, right?
Yep.
Generally an American-made vodka, you think of Tito's, and that's it. Okay, on American made, right?
Yeah, no, to be honest, I wouldn't have even thought of Tito's.
I didn't know that it was made in America, but Tito's is definitely like a big one.
Oh, well, Tito's sells 12 million cases a year. The next biggest is like probably not even 1 million. It's insane. Wow. And so I was like, I don't get it. There's not an industry in anything, like from golf clubs to workout clothes that, you guys might wear aloe or like something like, but you can
that's like literally what she's wearing.
I'm like looking for.
Oh, you're sponsored by them. Okay.
Not really, but if they want to.
Think about 3 different brands that are like that, your peers wear. Okay. Yeah, it's not just out, right? Like you could think. Yeah. So, and I was like, why does no one give a shit about American vodka? And like people were conditioned, it's the most drank spirit. And they were conditioned that it's odorless, tasteless, and you'll just mix it with something.
Yep.
I don't think it's odorless and I don't think it's tasteless. Okay. And I was like, why shouldn't we get something that you could stand on its own? And I was like, why can't, so again, being an entrepreneur in other businesses allowed me to bring like just a different perspective. And so I was like, why can't there be a premium American vodka to compete with like the overseas guys?
Yeah.
And so we're made in Idaho, red winter wheat, Snake River, organic. It's organic process, gluten-free. And I was like, we're going to create this like premium story to it. that actually sip it on its own. So we're really good in the martini because like you really get the benefit of it.
I'm actually really excited to try this now.
Yeah, we're
wait
getting
for June.
Kristen, give it a month.
And then, but the other thing, I was like, I have a great CEO, a woman named Rebecca Running, who runs the business for me. I said, Rebecca, is there like a law? That's what I said, like that says like the label of a vodka bottle has to be light colored with dark writing. Because that's every vodka is a light label with dark writing. And she's like, no, there's no law. I'm like, but like they all are. And so I went to a branding agency. I was like, I want to do something different. I was like, why wouldn't I want my bottle to like pop from a bar, from being on the bar? I'm like, okay, I want something that's going to pop out.
It pops
at you, right? Yeah. And so like, and you know, and I tried to make the bottle different, like it's embossed on the back. So if you wanted to like turn this into a water bottle afterwards at a restaurant, like I tried to just think of like other things that could happen.
Yeah.
Well,
or like what I see in kids' dorm rooms.
Yeah.
So, it's funny. My daughter's in college, and she's like, every time I visit her, she's like, "Can you bring some American Harvest out?"
She's having the classiest frat parties.
Exactly right. I was like,
make sure must be pretty popular having a father who owns a alcohol.
Right. Way cooler for that than sports teams, right? You know, we're only at this, like I said, like a little under 3 years now, but we're having great penetration. So if you go to the Capitol Grill, we're the espresso martini. And so we're getting restaurants, high-end restaurants to understand that like, hey, you're so discerning about where the food's coming from and everything else, but why do you still have like kind of a bland cocktail menu with just a rudimentary vodka? Why not have something high-end? So there's a great members club in New York, Zero Bond. Okay.
Yep.
So you know, so Scott, the owner,
we are not members, by the way.
No, we're not members, but I know it. But
so I'm a member. And Scott, the owner, said, "I'm going to put your vodka on there," and it says like American Harvest Organic Vodka. And he did it, you know, when he first opened 3 years ago. When he's like, "I'm doing that because no one knows what this is, and they're going to think I'm really discerning about it." Now, like, hopefully, a little more people know about us. But again, the goal is to like create a product that people can really think is, you know, special, and we put time in it no differently than a bourbon or some other dark spirit. And so, you know, we're still early in it. The jury's still out. Unique business compared to others I'm in because of the fact that there's a distributor involved. So alcohol is still very archaic in how it's distributed. And literally, like, to you, I have to give it to the distributor. They take their piece. Then it goes to the retailer, and then you get it, right? So, like, a lot of hands.
I know nothing about this distributor model. How does this work? Like, how do you become a distributor?
Well, yeah, there's like a handful in the country, and they've been around forever. And like, good luck getting into the business. Like,
oh, really? So it's like
Jen, I don't
the
think
distributor
on your business plan.
I don't want the distributors get mad at me, but it's like the mob. I mean, it's like literally like they just control it, and like, you know, you're just along for the ride.
Crazy.
Yeah, it's crazy. It's insane. Like, you can't go direct to consumer.
Why not?
Because
why not me? Why not you? Why not you?
Because that's to go through a distributor.
But it's interesting, right? Because there's so many other parts of the beverage industry that are now DTC, right? I have seen, I cannot stop the flood of marketing from like every single cannabis-based beverage trying to get me to order it. Yep. Why not alcohol? Is that a legal requirement?
You know, it is, but I think, look, in today's day and age, it's very easy to verify age, right? You could easily do that in a way where you could do it direct to consumer. I got to like watch out and make sure the distributors don't come after me. But
sorry, we can edit that out if you want. I was just curious.
But that's really, I mean, that's what's going on there.
Interesting.
Yeah.
And was there any big decision-making process around making it an American-produced product, or did you just happen to get lucky prior to all of the tariffs coming into place that are now impacting a lot of the big celebrity-owned tequila brands and things like that? Yeah,
no, it was American-made. So it was an existing brand that I bought and rebranded and redid.
Oh, cool.
And look, I think the American thing, this is a good time to be an American-made spirit, for sure.
Well, I think I feel like I should look up the exact number, but I had posted a snarky story on Instagram because there was an article how like wealthy wine collectors are going to have to pay up for like European wine. And I'm like, dude, it's not just the wealthy people. It's the people who want to buy their champagne, you know, like sparkling wine as great. And I love the California sparklings, like Stromberg is one of my favorites.
Champagne, yep.
But it's not champagne, you know? Correct. So it's the tariffs are no joke. Yeah.
They are no joke. Yeah. Now, the interesting thing is there was always tariffs if you were selling US based product overseas. People don't talk about that.
Why had we not put tariffs on before? Is it because there was such a
I just think no one paid attention to it. I'm certainly, I'll say what I don't know. I'm no expert on it, but again, there's all this hysteria over tariffs. And my understanding is the majority of the tariffs that are being contemplated are all reciprocal. They're not net new. Okay. And that's a big difference that people aren't talking about. But all we're doing is, creating equilibrium with someone who's been tariffing and taxing the shit out of us on the way in.
Interesting.
So, someone else smarter than me. You'll have someone else smarter that's an expert on tariffs on.
We'll try to dig into that. This has been absolutely fascinating, though. David, what's next? I mean, the past 3 years sound like they have been utterly. You have done more in the past 3 years than most people have done in 10 lifetimes. What are you excited about next?
Yeah, we're working on a few things. Philadelphia. I'm part of the group, the effort we're leading to try and get a WNBA team in Philadelphia. Hopefully by the time this airs, in a few, we should hear.
We want to publish this on Saturday, David. You got to hop to it.
All right, I got to work harder. I don't know if that's going to happen, but so we think that it would do great in Philadelphia, passionate fan base as it is, and all that, and we just don't know yet. And then we'll see what else finds me. I think I mentioned I don't sit still. I love business. I love this stuff, and so I'm always looking for the next fun thing to do.
Oh, that's amazing. Well, if our listeners want to follow you, you are very active on Instagram. You have a great following there. We'll share your Instagram handle.
It's just David Adelman.
Yes.
Yeah,
okay, great. Where else can they find you?
Yeah, no, with that, I do Twitter a little bit. I was really back in the day, I toned that down during the community engagement for the arena. For whatever reason, more people come after you on Twitter than they do.
I'm sure.
On the other platforms.
We're not on Twitter for that exact reason. We're free.
That's why.
So you don't need to. But so I was heavily engaged, and I was kind of almost like Mark Cuban-esque, firing back at people. And literally, it's a great story. There's a great guy who's our head of comms at the Sixers. His name's Dave Schaller. And one day he's like, "Hey," and I don't know if he said it exactly like this, but this is how I heard it. He's like, how to release nuclear weapons, there's 2 keys.
Yeah.
He's like, would you be willing to let me see your tweets before they go out?
That's amazing.
In some sort of way like that. And so, I've
we have 2 keys here. The Chris and I are the 2 key system too.
So really this. Then I post we post business content, stuff that our Darco Capital does on LinkedIn and stuff like that. So, but
it's very cool.
Really where I'm trying to share the stuff we're doing and having fun.
Well, we'll share all of those links in the show notes. David, this has been absolutely amazing. We're so happy that we got to meet you and got to have this extended conversation. Any parting words of wisdom for young people thinking about starting their careers?
Don't be afraid to fail. I say it all the time. Swing hard and, try again. I say to everyone, if I took no for an answer, I wouldn't have my awesome wife. So she said no at first.
Speaking of your wife, she's a children's book author, right?
She is. She's amazing. Haley is. She writes children's books, a great series called Way Past. So it's all about feelings, way past mad, sad, happy, shame, all this stuff. And then she makes documentary films, cause-based films.
Oh, what are the documentaries about?
She's got a great one on Netflix right now called Daughters. That's really good. She did one called Social Dilemma.
Not The Social Dilemma.
Yeah.
Oh, wow.
The one about,
yeah, we saw that documentary. That's amazing.
Yeah.
Shit. So she's legit.
Yeah. She was that. She had one. She was up for an Oscar this year for one. Documentary short called Death by Numbers. That was about the Parkland shooting.
Oh my God.
I mean, again, not, but
Chris is
no. But sorry. It was just the recognition, because you were she's because anyone
The
is
Social
awesome.
Dilemma.
She's
for
legit.
People who haven't seen it, is one of the best documentaries I've watched in the past 10 years.
Yeah. She's got another one that look out for that won some awards at Sundance called Librarians, which is good. She had another one called Speak. She's got a few that are out there that are really. Yeah, she's way more impressive than I am. So
that's amazing.
We'll have to get her on here next.
Yes, absolutely. Well, you guys are great. And Kristen, good luck with the number 4.
Thank you.
All right. We wish you luck. And then we'll all have a drink when you're on the other side of that.